Hi, I'm Richard Vague with Tycos. The economic headlines for the first quarter of 2025 came as a surprise. After 3 consecutive years of steady growth, the U.S. economy contracted at an annualized rate of 0.5%. That sounds unsettling, suggesting perhaps the economy has suddenly stumbled. But as often the case, there's more to this story than the initial numbers suggest. Let's step back for a moment and put this into perspective. From 2022 through the end of 2024, our economy had been averaging about 2.9% annualized growth, strong, though in part simply reflective of the rebound from COVID lows. Nevertheless, when we see a contraction like we just saw in the first quarter of 2025, it immediately stands out. On July 30th, we'll learn what the growth rate in the second quarter was and whether what we saw in the first quarter was an aberration. We'll be watching that like a hawk, and we'll be back with our report on that at the beginning of August. As regards the contraction in the first quarter, much of this drop can be explained by some very specific factors. First, we saw an unusual spike in imports, particularly pharmaceuticals and electronics. Imports surged at an annual rate of nearly 39%, driven partly by businesses scrambling and rushing to beat the new tariff hikes, and that subtracted about 4.7 percentage points from GDP. That's a lot. Remember, net imports reduce GDP. Additionally, businesses in that same panic built up inventories significantly as insurance against future supply chain disruptions. This inventory buildup actually added 2.6 percentage points back to GDP. If you assume that neither of these would have occurred if not for the scramble to cope with high tariffs, and you remove both the import surge and the inventory spike, the underlying story becomes clearer. Domestic economic activity grew at roughly a 1.5% annualized rate. That is certainly softer than the previous trend, but still positive. But beneath these fluctuations lies a more significant concern. Consumer spending, the reliable engine driving about 70% of GDP, slowed sharply. After running at a quarterly average of 2.6% over the last 3 years, personal expenditures managed barely 0.5% growth this quarter. This weakening of consumer demand is the real caution sign most economists are tracking most closely. Looking ahead to the second quarter, real-time indicators suggest we may see a rebound. The Atlanta Fed's GP Now statistic, its real-time forecast, is calling for around 2.5% growth, though many private forecasters are a bit more reserved, predicting closer to 1.5%. Both camps assume the unusual trade and inventory swings will normalize, removing last quarter's statistical distortions, though I guess you never know. Taking a broader view of 2025, consensus estimates cluster around a modest 1.5% growth rate for the full year. This is certainly slower than recent years. If consumer spending cools further, or worse, stagnates, we'll see those estimates slide toward the lower end. Forecasters also expect some of the smaller GDP engines to cool in 2025. Business investment is projected to barely grow after firms front-loaded equipment purchases in the first quarter. Residential construction is set to contract again under the weight of 7% mortgage rates, and federal spending, which gave GDP a mild lift last year, is now expected to slip slightly and may even turn into a small drag. Together, these softer components will add to the headwind already coming from slower consumer demand. So as we sharpen our own 2025 forecast, we will first take into account the slowed consumer spending. But the forecast for 2025 and beyond hinges as much or more on the massive changes in major governmental policies being advanced so rapidly by the Trump administration, namely the impact of tariffs, the impact of the immigration shutdown, then the early impact of Trump's big, beautiful bill, not to mention the continuing layoff possibilities. So next week, we'll examine the possible dimensions of each of these. That should be fun. That's it for this week. Thanks for watching.